Welcome to Equity Story Trade Watch, the 1st of March. So we're just over the reporting season, Claude, and welcome. I'm so glad this is over. I don't like these months where we've just got so much information overload. It gets a bit tedious and very fluctuating. You can have a really good day with good results, and then the next day you've got really bad results and you think, what am I doing?
Yeah, it's been a fairly tough earnings season so far as well.
Yes, exactly.
I think we are starting to see some of those like earnings rollover. Obviously, still a lot of strength in like mining services and that kind of stuff, but everything else has been not so good.
So it's good to just have a little bit of a quiet month because next month we've got the quarterly season again. So March will give us time to reflect, go through some of our portfolios, do a bit of a spring clean, and see how we go. So before we start, and we're going to talk about, really, there's not much information this morning from companies themselves, but we're going to focus on our talk of the week, so thought of the week. But before we do that, we will go and just mention that this is general advice only. You've got this in front of you. Every stock we talk about is pretty much focused on the technicals or the fundamentals of it. So I am going to quickly switch on to the charting.
That sounds good. Oh, I might just jump in there since you mentioned a spring clean, Peter. I wanted to make sure Equity Story members are the first to know. On Friday, I'll probably explain this in an article to a Rich Life readers. But what I'm actually planning to do in the coming few weeks or months is essentially get my portfolio aligned with my official recommendations on a Rich Life, which are only available to Rich Life subscribers. But essentially what that's going to mean is whether I like them or not, or whatever I think of the stocks, I'm going to be selling everything except for these official recommendations, of which there are 5 at the moment, plus also except for Pro Medicus, which I'm going to be keeping. And that's because, look, it's all capital gains to me. I have big tax consequences if I sell it. On top of that, I have, been covering the stock widely for almost 10 years now. And I think it's the highest quality business on the ASX. And I just feel like it would be poor. I wouldn't be eating my own cooking if I didn't own Pro Medicus at all times. So I feel like I can't sell that one. Not going to sell that one. Not going to sell the official buy recommendations, of course. And I'm just going to sell everything else, start again. I'll probably end up doing buy recommendations on some of the stocks I own now that I'm going to sell. But this is a way for me to get completely aligned with the advice that I'm giving, and I'm going to feel better about that.
Fair enough. And should I just clarify that it's not a spring clean, it's going to be an autumn clean.
Yeah, it'll be an autumn clean. And I'll be looking to, rebuild pretty quickly as well. But yeah, that's sort of where I'm thinking about at the moment.
Yeah, look, I think it's, I think we normally do that with our portfolio. We should be doing anyway with our portfolio, looking after the reporting season, what needs to go, what needs to stay. It's a good excuse to go through it.
Look, I just wanted to put it out there in case someone thinks, oh, Claude, you were saying you owned this stock and you liked it, and now you're saying you don't own it anymore. Well, the reason is because I never made it an official recommendation. And it doesn't, look, part of it comes from the fact that my official recommendations tend to have been so far more, I guess, longer term growth stories that haven't performed so well. But some of the other stocks I've been buying recently but didn't make official recommendations were mining services companies that have reported well and have gone up. And I feel bad because I wish I made them the official recommendations, and I feel bad now that I bought these ones but I didn't make them a recommendation, and I really want to avoid that situation in the future.
Fair point. All right, so we're all going to do a autumn clean out, and we're going to obviously talk about some more stocks and which ones we're going to be looking at. And this is part of what we do here on Equity Story, and especially what we do here when we look at some of these announcements and our thought of the week. So first of all, announcements this morning, really zero. So I'm glad, because we've obviously had that pretty busy period. There was nothing really caught my eye. I looked at the markets last night. I think the Dow was down and Nasdaq was up slightly, but generally feeling I'm still sticking to that notion that we looked at the charts at the end of the last week, thinking there might be some volatility, might be some weakness. That's why we're a little bit cautious about the tech stocks. So I'm still sticking with that. However, there's no time to panic. Just have a look at your portfolio, start looking at what's working for you, what's not working for you, and take it from there. So everyone, you should be going through every single stock and just reassessing it to see where it still fits in your portfolio. All right, saying that, Claude, let's go straight. We're going to go jumping straight into that thought of the week, because now we've got end of the reporting season. We've had the first 2 weeks. We've had our ideas. Last week, there's also a plethora of different results coming out. Is there anything that caught your eye? Because I've got one I'm going to talk about that I've probably harped on about it many times before, but it really caught my eye this time around because I can see there's a now step change where I can see a re-rating for this story. So that's why I'm going to talk about it.
I reckon an inflection point. Let's get straight into your one.
Okay, let's go. And it is DSE drops week, right? So you can see the charts. So first of all, I'm going to put the chart on and I'm going to bring out the actual announcement so you can see why I'm looking so positively on it. And it's been trading sideways, and I'm going to go back a little bit longer to this. It's been trading sideways probably since January 21. So that's about 2 years, right? It's been around at 18 about 18 to about 22, 23 cents. I think now, 2 years down the track, they've had that growth period where they've gone from below 10 million bucks in revenues to now announcing about 20 million in revenues, right? So to me, that's sort of the figures now I'm starting to look at a bit more seriously, where this company is heading into a larger space where there'll be more interested parties looking at this story. And possibly if that happens, you're going to probably just see out of just the weight of money probably moving it forward. But why do I like it? So I'm just going to go back and bring it up again because I've just lost it somewhere. I had it just before. So just give me a second. So here we go. I want to go to the presentation. Actually, I'll go to results because that's probably going to be easier. So as you can see, this is the page that really is, for me, summarizes everything pretty well, right? So you've got the record AAO, annual recurring revenues. They've been growing quite nicely, but obviously it's not reflective of what the underlying revenues are. And when you look at the actual underlying revenues are actually very good. So you've got total FY22 revenues of 20.7 million. So that's up from 11.7, 63% growth. So straight off, their revenue growth for me is super attractive at these sort of rates. You look at the EBITDA, they're positive. So they are focusing on the bottom line, and they have been doing that for some time. So it's not one of these companies that all of a sudden, market doesn't like the unprofitable companies. We're going to do something about it. Let's fire everyone. That's not what they do. They're actually looking at growing sustainably without that ridiculous overspend on things, right? I like that from this. This company has been focused on that for a long time. So that's one thing. You can see that the operating cash flows, improving every single year for the last 4 years. You gotta really respect that from that point. And for the first time ever, this is the inflection point for me, Claude. It's profitable. It's got a PE ratio. Oh my God, what's going on? I mean, I'm super excited.
It's a great thing to see, Peter.
I know. Yeah. Doesn't matter if it's 1,000, but I'm happy it's got a PE ratio, which for a tech stock is a huge tick of approval. And
I think there's a couple of things we can also say. It's a genuine profit. It's not some sort of, we're recognizing our tax losses or whatever. And it's not just an accounting profit. It's like a genuine profit.
Exactly. It's actually
somewhat
hard work profits, Claude. That's what it is, right? They're doing it the right way. So for me, that also another one that's really important, the ARPU. There's a lot of companies in this space, right? They're obviously growing their revenues, but they're growing it through, means maybe where they are acquiring stuff. And this is one of the other things. This is all organic. My goodness me, you look at it, 60% growth and it's organic. Wowee. I mean, that is very, very impressive.
And I think that the final point that I'd chuck in to support what you're saying is that I've got to check, but from memory, when I looked at the results, the gross profit is, if anything, growing a tad faster than the revenue, which is really great to see because it means that, again, you're talking about the revenue growth. Sometimes a pitfall can be, the revenue went up, but the margins went down. Exactly. So no good. Right. And that's not what we're seeing either. So like all the signs are saying that this is actually crossing an inflection point, and that is great to see.
All the signs are saying, buy me. That's what it's saying to me. And the last thing I want to cover, and this is all the positive, and I'll tell you the negatives in a second, right? So I'm going to start with the positive. The last one is the cash, because a lot of these companies have got issues. where maybe they don't have enough cash, and then they go to the market and then they loot, and everyone goes, oh, well, I'm going to sell this because it's just, there's no point. 22 million, 22.3, they've actually gone up from 21.6. So you can see this is really good little company here, and it's in the right space. Cybersecurity, for me, is the place to be probably for the next decade at least, right? Maybe even longer, maybe forever type stuff. All right, so let's look at the negatives. It's a small little company, right? For me, once it gets to 20 million, it's harder to grow the revenues the higher you get, unless you've got a really genuine product on your or service that you've got. So you can easily get to maybe 0 to 20 just by maybe, coming up with something new, and people get excited about it. But now it's going to be that this is going to sort out the man from the boys, and let's just see how this goes. So that's the first thing. Second of all, and we talked about it just before, and I completely agree. It doesn't have a moat. Anyone can do this. There's a lot of companies out there doing exactly the same thing.
Well, to the extent it has a moat, it's like a sort of more flimsy sort of relationship-based moat, right? Like,
yeah, but it's not really. It's nothing. I can't see anything world breaking or world leading where they've got
the point is they're not going to have pricing power.
No, that's right. So for me, it's all about relationships, all about just getting some market share in this space, and knowing that, at least from the point of view that cybersecurity is such a very strong theme at the moment, that pretty much every single company in there has to protect themselves, have to protect their own data, and this is exactly what these guys do, right? I think just with time, if they can just execute on their sales, show the benefits to companies, some smaller companies will definitely jump on board. And I think they are one of the best performers for Microsoft that they're talking about, the partnership they've got in there. So for me, partnering up with a big company at Microsoft is very, very positive for me. So all in all, I think, the negatives are there, but the positive far away. So I still think, even if they've got maybe a cap somewhere, right, upward, I think they can easily get to at least maybe $1 billion market valuation, right? If they can just grab a certain amount of market share in this space, because there's definitely a possibility for me. I can see it. If I close my eyes, think about the sales, the companies that need this sort of product, they're expanding through just coming up with new products. This is the beauty about this company. They don't have to acquire anything to grow, but they are looking at acquisitions. So potentially there might be something as well on there that's could get excited. I mean, I love the way they've grown so far, but if they acquire something that's can add so much value, then so be it. Let's see how they go. So for me, overall, I'm really digging this company, that Claude, at the moment. I think this is inflection point, profitable. It's time for a re-rate of for me. So I can see this finally getting through maybe that 22.5, 23 level, 24 level, and getting it at 30 cents plus, and maybe finding new highs over the next 12 months. So it's time to probably last bell to get on, unless obviously you've got market problems where it might still be difficult for these tech companies. I've got a feeling we're getting there. We're getting there, and we're just about to move up higher. All right. That's my little beauty. That was just a great little result. I really love that. Over to you, Claude. What have you got for us? And I know you've got a couple of real beauties.
All right, so I'm going to start with like the safe and nice one, which is EBOS Group, EBO.
Okay, so I'm going to get into trouble.
Now, so there's some risk around these results just because they did a big acquisition, in the last year sort of thing. Like last year they did it, but that's where they had to have a lot of growth coming from this acquired Life Healthcare, which does joint replacement kind of stuff. Your knee, the actual implant that goes in your knee if you get a replaced knee or whatever, they do those things. So big acquisition there, bit of risk if that doesn't perform. Good relief for everybody who's a shareholder, such as myself, that they did perform with these results. You got the EPS growth you're expecting. You got the free cash flow, good free cash flow going up. Now, this is a capital intensive business. It's a distributor, earns like 3.5% margins. So it's not an amazing, high margin business, but it's in healthcare. So Terry White Chemists, I'm sure everybody's seen or even gone to. That's what EBOS has in Australia, and ChemMart as well. They have, one of the largest medical distribution companies in Australia. one of their competitors has really struggled in recent years. Like they've just been badly managed. They didn't have the systems and they lost volumes from that. So that's been a free kick for EBOS as well. They're a well-managed company, headquartered in New Zealand, massive operations in Australia, pay a little dividend. The dividend's probably what you want to rate it on, which by which measure right now, it's not looking cheap, by the way. So you can't call it a dividend stock anymore right now just because the share price has moved so high. When I bought it, I would argue it was a dividend stock. But this is a blue chip stock that not many people have heard about, and they did good results. Everything's looking good for them. You got to remember, they got massive tailwinds, Peter. Not only do you have an aging population, all need for medicine benefits these guys, right? The reason I monitor that free cash flow is because the one thing that can hurt them is they have to fund these massive inventories, right? So that's why you want to watch the free cash flow, make sure their funding's all good. It is at the moment, so that's fine. And then, yeah, look, it's every tailwind you want. Like obesity is increasing. Guess what? If people are bigger, they're more likely to need a hip or knee replacement because of the strain that puts on your joints. That's going to help them. People are sicker. COVID, people get COVID. That hurts your immune system. You get sicker from other things, blah, blah, blah. Every tailwind is in these guys' favor. And I've said it a million times, distributors with strong demand, they in a situation where they get stronger because, yeah, margins are low and you need scale. So how can anyone ever compete? It's essentially they can't. These guys are winning in their little segment, which is healthcare distribution. That could go on for 5-10 years. Ergo, good blue chip shot, good blue chip stock that honestly you just don't get reading about on the AFR very much or anyone really talking about.
I find it fascinating that you don't like blue chips yet. This is a really good blue chip.
Yeah, well, so the thing is, the reason I ended up in this one is because when we had the panic sell-off in the COVID thing, I was just like, I'm going to buy something super safe. So I piled into this and then, it's performed quite well. So it never gave me a reason to sell, basically.
Look, Claude, I have to completely agree. I think this is one of the best quality stocks, right, around. I really like it too myself. And you can see the chart is fantastic. It's been a great performer over a long period of time. You can see I'm putting it on a 5-year chart and it's just been going up and up and up. So long-term buy, I've got no problems with buying it at these levels, long-term buy whatsoever. Very good performance. So I'm just going to quickly go and just show everyone the P ratios and some of the other statistics on here. So we've got EBOS trading on 33 times. It's actually not that bad. I don't mind a company that's really quality, that's been performing for a long time, to paying around these levels for a longer term. So
the chances of it continuing to grow are quite good for like many years. So that's good. I'm not sure it's necessarily undervalued. So it was a bit opportunistic when I bought it as well. Like hindsight, one of the best setups I've ever seen. What happened was a huge shareholder was selling down and in September 2020, and that put pressure on the share price. So yeah, like it was just, they were selling down probably for kind of unrelated reasons. They were like exiting their investment. So, and they did it in a big block trade, but then that just put pressure on the share price for a while. And that's when I bought. So it was undervalued then. I think it's probably fairly valued now, but it's still something like you can trend it. You can, like, it's a safe-ish place to play in my opinion.
Absolutely. I know that, like you said, the healthcare space, I think it's going to be here forever. So, you're going to a fairly defensive position. It doesn't matter what market you're in. So for me, very, very good investment for a longer investor out there, right? So absolutely agree with you. I mean, like I said, I don't mind paying 33 times for this company. Chart looks great. Great results. I can see on here we've got I think underlying total revenue of up 17%. I mean, that's pretty impressive. Yeah. Dig it.
Acquisition in that as well, but they got organic growth as well. So like overall, yeah, great, good results. And then I guess for something a little bit more spicy, we have XRF Scientific, which we've talked about a bunch of times before. Obviously, I own this one as well. Look, the setup looks like a lot better for the near term for these guys. Look, if you're going to look at it, you're going to see a P ratio of 23, and that's going to probably feel, yeah, like fairly high for a cyclical business. But you've actually, you can simply say, well, actually, the basic earnings per share in the last half were 2.8 cents per share. Now, even if you get no growth half on half, that takes you to 5.6 cents for the full year. And then with your share price being, essentially $1, that's actually a PE ratio of a bit lower than, 17.8 or whatever there. So it's no longer super cheap, but it's not, it's growing. So its PE ratio is probably justified, perhaps more than justified. And what I thought was interesting about these results and why it deserved a thought of the week highlight is because they were great results. Every single segment did well. And it's a cyclical business, right? So I'm going to be talking to the CEO and try and find out more about this, but this thing has just absolutely had an incredible run in terms of its demand, and it's been quite well managed. So they've really gotten the strong demand to come and translate into profits. So that's really great to see. Now, the problem with that is, the demand might not last forever. They said in their results, and I thought that they were fair and honest. They said we had very strong demand from mining industrial customers. Basically, you can basically be sure that if that demand does start to go in the other direction, so too will their profit, because every single one of their segments, it has high operating leverage in it. The one good thing about it, the one reason why this sets itself apart from some other mining services company is it has a portion of its revenue which is usage based. So they sell their machines for the analysis of rock segments, and then they make profits selling consumables for those machines.
And service.
Yeah. So that's what I really like about it. That's 2.5 million profit before tax from that usage-based thing. So now that this company's gotten bigger and it's gotten more of its machines out there, you could be pretty confident that it would be very, very, very hard for this company to actually become in super distress. That doesn't mean the share price won't go down. Earnings could go down because there's a good half of their revenue, actually a good half of their profit, actually a little bit more than half of their profit, not much more, but a little bit more than half of their profit is coming from the capital sales kind of side of the business, or the precious metals segment. But ultimately, now the consumables side of the business, which is probably going to keep going, it might go down a little bit in a mining bust, but it's probably going to keep going one way or another. That's going to keep the business going, essentially. So it's not the kind of mining service business that has an absolute ton of debt. You could suddenly see it, probably people forgotten now, but in a mining bust, you get all these mining service companies, they've taken on too much debt, they've got too many liabilities, suddenly their profit drops, and holy moly, like they could go bankrupt. And that's why you get these like precipitous, 80% drops in them. Yes, this could drop, but it looks like it's actually a sturdier business than most in the segment, and that'll give it a good platform to get through hard times, even maybe take advantage of them by making acquisitions, and then exceed again in the good times. So from now on, this will be a stock that I'll be following no matter what from now, because I think it's like one of the higher quality mining service companies. Doesn't mean I'll be a long-term holder because it's so cyclical. So I do think it's one you got to sell when the cycle turns. Right now, the cycle's still strong. And I say, you can keep dancing until we start to see that demand wane off.
Until the music stops.
Yeah.
I agree. Again, I love the story. We both like it. We're following it. Chart looks again fantastic. Look, chart-wise anyway, it could come down to 85 cents again, back to that red line. No problems. There's no panic if it does that. It's just normal market fluctuations, because we're looking at the actual underlying performance of the company. I mean, ultimately that's the most important thing for us. And I remember, Claude, looking at this company, I'm questioning it. Should I be selling it? I think I bought it back in October, I think back last year, and I came back to this trend lines around 75. So I'm thinking, should I be holding it? And then I'm sort of going back to my thesis. Why did I buy it in the first place, right? Strong results, strong outlook. Hold on. What are you doing? Slap myself in the face a bit, right? And then I went bang again. And then I thought, I'm just going to hold this. This is really good, right? And
I reckon it's one of those ones you want to like make sure the position size not too bad. Like you don't want it to be a mega position size because, you know, it could be when demand falls off the first time we really realize that is when it puts through weak results.
Exactly.
In terms of like, yeah, like these things, you don't know, like if demand doesn't go off, profit keeps going up, you know? And so the risk
So far, so good. So, you know, we've got our fingers crossed that they're going to keep coming up with another 12 months of really strong result.
From like new mines. So like, as long as there's like Australia's like cashing in on like, you know, any commodity, it's not like it has to be like coal prices are high or prices are high. You just need like, if lithium's high, that's good. That's going to help these guys. Like whatever it is, it's going to help. So, yeah, just an interesting one there to watch, but pro-cyclical. So yeah, don't, I wouldn't be like, I'm going to long-term buy and hold this forever. Put it that way.
Alrighty. So that's 3 really great stocks we talked about today. So think about that, whether it fits into your portfolio, whether you like the stories. So thank you very much, Claude, for coming on today and talking stocks with a little bit of technicals just to satisfy the hound out there. But generally, it's obviously just we're talking about fundamentals of the stuff. So thank you. Have a great the rest of the week, and I'll speak to you probably going on Friday talking about Ask the Analyst again.
Oh, I'll be on the call this Friday, so you'll miss out.
All right, fair enough. Fair enough.
But anyway, thanks for watching, everybody, and have a great day.
All right, cheers, guys. Bye.